Welcome back on the AM show. Now let's bring you AM business for today, because savings and loans institutions have contributed to Ghana's economy, especially to the small and medium-scale enterprises. But the sector is bedeviled with some challenges, and James Shen has been engaging the Chief Executive Officer of Opportunity International Savings and Loans and former board chair of the Ghana Association of Savings and Loans Companies, Owusu Boateng, today on AM Business.
Categorized as a non-bank financial institution in our part of the world, savings and loans companies are backbone to massive economic growth and development. But this sector has been affected by some challenges. I mean, they stay afloat, but no matter what, there are some form of challenges that affect their operations. To help me better understand what is really going on in this particular space, as the former board chair of the Ghana Association of Savings and Loans, and also the Chief Executive Officer of Opportunity International Savings and Loan Companies, in the person of Owusu Boateng. Mr. Boateng, we've started a new government. We've seen the new government. We've seen what happened from the old government. How is the year going so far for you guys?
Thank you once again, and thanks for the opportunity to share perspectives about the sector. Firstly, it's very early in the new year, very early in the life of a new government to appreciate the kind of dynamics that are going to come to bear and how that is going to impact on our work. But there are huge expectations, given where we have come from, the periods and the latter part of 2018 through 2020, the banking crisis and its impact on the sector. Just when we're recovering, then COVID, with its whole global impact also affecting. And just when most institutions have come out, then we have to go through another change of government. Of course, largely good for the country, for the peace that we've had so far. So it's interesting, but exciting.
Now, talking about your recovery from COVID, the financial sector cleanup in 2017, 2019, all the last year, you raised some concerns during one of your annual general meetings with respect to the fact that you spoke about NPLs. You've also spoken about some payments that need to be done and all of that. But I'll come to that. But let's just look at the state of this particular sector from last year to the first quarter of this year as we find ourselves now.
The sector has 26 institutions as at the end of 2024. Out of these 26, I must say that a few of them may have some few challenges, but there's been progress from 2020 up to date in terms of sustainable institutions that are practicing the sector. There's been progress in terms of the governance framework, the governance structures that most institutions are imbibing, the risk management framework, and all. So I would say that comparatively over the past 4 years, there's been much improvement, given the work that the association has also done together with the central bank in helping the institutions to come up or to improve on their various operational activities.
Within the first week of this year, your executive secretary for the association, Boateng, raised concerns of some savings and loans companies being collapsing or will be collapsing based on some NPLs and all of that. What is the state of NPLs as we speak now?
The sector has an average of about 14% NPL ratio across the 26 institutions that I talked about. It's not that the institutions are collapsing, but the impact of NPLs on the institutions, because it erodes shareholder capital, it erodes shareholder value, it erodes profitability and all. And therefore, it's a critical piece, especially for a microfinance sector like we have. So your ability as an individual institution and as a sector to deal with NPLs inures to the benefit of the institution in terms of sustainability. So that's where I believe my executive secretary, Mr. Boateng, was coming from.
But you've made us understand some of these NPLs are from the public sector workers, but some are also of the concerns that, okay, savings and loans came in to support SMEs and all of that. Why don't you revisit your first love?
There are different categories of savings and loans companies in terms of product mix. There are some that focus largely on salary loans, and that's their core product. There are some, like my institution, that has a balance between salary loans, which is a very small percentage of our portfolio, not even up to 10%, compared to agriculture, education, commerce, and etc. that we focus on. So it depends on each individual institution's strategy. For those that have salary loans or the controller loans as a core product, they have been really hit by the exodus of public sector workers. And that's why we raised that issue during the AGM. And Tinubu also emphasized it a week ago.
I know you are a former board chair now, but how are you guys handling this public sector? Are we to expect you withdraw, I mean, giving out loans to these people, or there will be a certain quota? What exactly should we expect? I mean, you're a former board chair. Definitely, your expertise within this space should tell us something.
What we expect to see is that there will be somewhat stringent assessment processes for various categories of salaried workers. Of course, it's not all salaried workers that are emigrating from Ghana. We have particular sectors that are living in large quantities. Those are the ones that various institutions will have different approaches in engaging potential clients who want to have access to funding from them. But it's not a blanket situation where you're going to say that all salary workers are going to be barred from accessing loans from such institutions. So for each category or each sector, there will be specific dynamics in terms of how the due diligence is done to ensure that depositors' money are also protected. Remember, the loans that we are giving out are also coming from depositors. So if we are losing it to salary workers who are traveling out of the country, then that erodes the depositors' money that we also hold.
What are these stringent measures? Is there a collaboration with the Ghana Airports Company, or what exactly?
Oh, not really. We have a very strong collaboration with the controller, accountant general that does the deductions and the disbursements, and also the particular institutions where these staff work. Sometimes there are guarantees from these institutions that cover such losses and etc. So those are the kind of frameworks that we're going to use to help protect the institutions.
What's the role of the regulator in ensuring that, or in basically addressing some of these challenges?
Well, when it comes to non-performing loans, the regulator has standards, directives that govern our operations. They set the benchmarks that we need to work with and etc. So institutions are supposed to work within those frameworks. So once you work within those frameworks and the risk management frameworks, then you expect that your standards, especially for non-performing loans, as we're talking about, is going to be within your risk appetite. Every institution has its own capacity in terms of risk that you want to take for particular sectors, for particular products. But normally what the regulator will do is to give you the guidelines, the regulatory framework. We have permissible activities for savings and loans companies. Once you are within the permissible activities that you are licensed to do, the regulator doesn't have a problem with you. So once you design your products, or we design our products in line with the permissible activities and the corporate governance directives and all the directives issued by the central bank, that's what the central bank does to guide us into our operations.
There have also been issues of high interest rates, especially when you visit these market women, you're being told, Yakwajilona, interest was strong. What is amounting to that particular high interest rate from your end?
The interest rate is a function of the market conditions. When you have treasury bills at 28%, and the government is borrowing from the public at 28%, then we are going deep into the markets. Remember, look at where savings and loans companies are located. Sometimes in the very remote communities where some universal banks wouldn't want to go. And therefore, the cost of operation is so high. If you don't have a very, very robust and efficient model, your costs will far outweigh the gains that you make from doing these loans. And most of these savings and loans companies have the mission to serve clients at the base of the pyramid. And therefore, serving those small ticket transactions, high-level retail, your cost of operations, rentals, everything in this country is going up. Inflation went all the way to the roof, about 50%. You have foreign denominated services related to IT and cybersecurity. If you are converting hard-earned CD to pay for these services, definitely it will impact on your cost of operations. And that is why the cost to the final customer at the retail end also is high, as has been indicated. But what we have to do continuously is to improve on our operations, improve on our efficiency levels, and cut back some of the costs so that we can pass the benefit to the customer. And I think that is improving. In the past, you could see some savings and loans charging above 60% and extra. Now I see some of my colleagues charging or issuing out loans within the 30% mark. So given market rates and doing within the 30% mark, I think that's an improvement, but there's still more room for improvement.
I want some bit of education here. As the sector also being affected that much by the high policy rate, because it's currently around 27%.
Yeah. So the fact is that no savings and loans company to date can borrow from the central bank at near policy rate. It's only the universal banks that can borrow from. That is the law that we have. So if a savings and loans company doesn't have adequate savings from customers and wants to lend, it has to borrow from the universal banks. Remember, the universal banks will borrow from the central bank plus a premium and issue that loan to the savings and loans company. So you can hardly compete with a universal bank when it comes to interest rate. And that's one of the fundamental flaws of our...
Do you think the regulator should probably find a way to deal with some of it?
Yeah, we have had conversations on this, and I remember during my time as chair of the association, we had engagements with the regulators on this. But to date, we haven't had a solution. So it's something that I believe the sector is going to pick up strongly with the new government, and we'll see how it goes. Because if we can also borrow directly from the central bank, then it gives us opportunity to also lower the interest rate for the customers, because we are accessing liquidity at a relatively lower cost compared to what we are doing now. Deposit mobilization is very expensive. And we use the SUSU methodology with our field officers, mobile bankers, all over the country to mobilize these savings. And it comes at a cost, it comes at a risk. And therefore, when you pass on these deposits as loans, definitely it's highly priced compared to what a universal bank would do.
But were you guys pushing that much? Pushing the regulator to make sure all these were done?
We did our best. There's an extent to which we could go.
But what was the feedback coming from the regulator?
It's more about a structural issue that's not easily done overnight. So there has to be some continuous engagement for a better understanding of the implications of that and how that will to our benefit going forward if that is reversed.
Now, let me bring you to the conversation of technology. For some time now, you've been pushing for technology within these institutions. What is the relationship between your space or the savings and loans companies and these fintech companies?
There are increasing levels of collaborations going on because, as I said earlier on, if you don't improve on the efficiency of your operations, you cannot really sustain your business, especially serving the clients, serving them in terms of the reach, the locations where we have to find them, and also convenience that we need to create for them. And therefore, I've seen that a number of institutions within the sector are embracing these fintechs and developing products and services tailor-made in line with their models for the customers. We, for instance, currently are partnered with fully digitalize our deposit services, where we have a USSD channel, and customers can access us from any location all over the world, not just in Ghana. So you don't need to go into our banking hall to access your savings. We're doing a similar project for our loan a solution so that clients can access loans from any location at all. And I know a number of savings and loans companies are doing similar collaborations.
Talking about technology and these fintechs definitely comes with challenges, cyber risk and all of that. We've seen most banks these days campaign against scammers online and all of that. Are you guys being also affected by such situations?
Thankfully, the central bank has a cyber security directive that governs all institutions, including banks, savings and loans companies. And that is helping us to assure that our systems are robust to prevent such cyber attacks. Dealing with cyber attacks is a continuous thing, and there are different stakeholders. You have your internal systems and processes, you have the customer, and you have the infrastructure providers. Continuous education of customers is key, and therefore, for us, we take financial literacy and client education seriously, because you can put in all the infrastructure. If the customers don't appreciate the dynamics, they will still fall victims to the fraudsters. So there are different areas we need to look at in dealing with cybersecurity. One, the institutions have to build the capacity, build high standards of the infrastructure related to cybersecurity in line with the corporate governance directives. The internal processes have to be organized in a way that prevents or is able to reduce or eliminate such threats, and the customers also have to be engaged and socialized and educated on practices within the cyberspace so that when they see an incoming threat, they're able to deal with it even from their perspective as well.
Now, let me still take you back to the cost of credit. How do we get our head around this? Because it's been difficult for especially the ordinary Ghanaian who want to go out there, you know what, how do we get our head around this?
I think that is a whole ecosystem of the market indicators. It doesn't rely on just one individual institution to say, I'll bring cost of credit below 20%. The whole ecosystem has to come together. So you see inflation, the forex, the cost of doing business, utilities, you know, all our branches. So we have 38 branches. If you don't have power, what you have to do is that you have to run 38 generators across this. And if the fuel is also high, there's a multiplier effect on that. So the whole ecosystem of the economics of running operations has to work in favor of all of us. It is in that situation that now institutions will begin to feel that their margins are not squeezed for sustainability reasons so that you don't pass on this cost to the customer. So it's the whole ecosystem of the market indicators, the operational efficiency of the institutions, and etc. The cost of money, like we said earlier on. The cost of money is high, the cost of delivering the credit to the customer. When I say cost of money, how you assess your funding. If you are assessing loans from local sources or even from international lenders, and the conditions are not favorable, the rates are not favorable, then definitely as you pass it on as loans, it's going to be at a higher rate. Some institutions actually even source foreign denominated currency loans. And if you are using CD to pay back these loans, it becomes very expensive. So it's a whole lot of things. Even the area of risk management is important for the cost of credit. Last year, we climaxed our 20th anniversary celebration. Having been in operation for the past 20 years, we've built a very significant operation over 670,000 depositors across 10 of the 16 regions of the country. There are plans to add a few more regions, starting from this year, where we plan to be in Volta region for the first time with a physical branch. We're looking at upcountry, Upper East, Upper West, Northeast as well, where we've done feasibility studies to also expand our footprint into those areas. What we're looking forward to do in 2025 is to combine our traditional model with technology as much as possible.
In speaking about the savings and loans sector, its growth prospect, challenges as well, and how best we can deal with some of these challenges affecting the sector. My name is James Chen, Joy Business.